me are Rachel and Zach for production and technology. If you want to participate, the chat box is open during the show and we will monitor what's coming in. However, email seems to be preferred way of communicating for most, and that's fine. Just don't be shy. Here are the handles where you can find me and also the email address at the top. Ladies and gentlemen, this is Sector Spotlight. What we'll be doing today, we will have our usual sector view overview. I'd like to take a little bit of a deeper dive into the financial sector. We'll have a break. We'll have the mailbag if anything comes in, or I have one, but it depends a little bit on the timing. And I'll come up with a new pair trade idea. Just for your information, I'm not sure how the timing will be, so that financials thing could be either before the break, after the break, or split into two. Just stay tuned and we'll find out. Let's go bring up some RRGs and some charts. Here is the performance of the various asset classes over the last 5 days since that we last spoke. Again, a very good week for the S&P 500, up 1.4%. And the weakest asset class was government bonds with minus 0.84. The 60/40 benchmark, VBINX, was up 0.6. If we put that all into a relative perspective, of course, equities remain the best, but you can see that T-bonds 7 to 10 years was really, really weak over the last 5 days in relative terms. Quick look at the RRG. SPY stocks, they remain solidly inside the leading quadrant. Flat momentum, but continues to travel to the right-hand side, which means that it is a very stable relative uptrend at positive momentum, but not gaining, which is good. And we'll see the complex of fixed income asset classes, government bonds here, high yield here, corporate bonds here, moving into the lagging quadrant, and real estate is rapidly approaching there. Commodities remain inside improving, but dropping rapidly on the momentum scale. If we switch this over to the sector performance and bring in sectors here, then of course a good week. All sectors were up. Strongest performance for energy, followed by financials, materials. S&P itself up 1.4, and the weakest sectors were utilities and real estate, and to a lesser extent healthcare. Again, if we bring that back to relative against the S&P 500, there's only 3 sectors that are causing an outperformance. That was energy, financials, and materials for the last 5 days. Utilities and real estate really, really weak. And that corresponds with what we're seeing on the RRG here on the right. We still have energy tucked away in the top left corner. Looks to be making a good move for, at least with yesterday's data coming in, but as you can see, still far away and disconnected from the rest. So I'd be really, really cautious with that one. We see this is staples and discretionary, real estate and utilities rapidly traveling further into the lagging quadrant. So these are the sectors to avoid. We've got materials and communications curling up slightly, and then we'll have a healthcare, financials, industrials, and technology inside leading, which is still, I would say, a bullish constellation for these sectors. Let me give a quick overview of my take on the S&P 500. The longer term picture is absolutely bullish. There's no doubt about that. That 300 line in the sand is still there. We had this move, 307 correction low, and we're now testing this 316 area, 316 level. This could be too much overhead supply for the short term. And push the market lower. I think that when that happens, that could, especially when we break below this 307 level, because that will, complete a small double top formation, provided that we're not going above 316. And that could provide actually a pretty good long-term buying opportunity somewhere above 300, so anywhere in this range here, actually. So that's the long-term picture, long-term bullish, short-term could be some overhead pressure offering new buying opportunities. If we go back to the sector view and go over some of these, one of the things that I'd like to share with you is a new thing that we have. If you haven't seen it yet, if you open up the sector, I was going to say, no, I need to open up my chart lists actually. Do that here. You go to your dashboard and you find your chart lists, and there is a new option. And if I go to the ETFs weekly, you see two little dots here, send daily report and send weekly report. What this will do is after the close of the market, it will send you a small performance report of all the holdings in this chart list. For me, these are sectors, but it can actually be anything. It could be a portfolio, could be a watch list, could be anything. So that I find that is a really cool addition to the tools that we have here on StockCharts.com. And it helps me to get a structured overview on a daily basis or a weekly basis of what's going on with the holdings or the ticker symbols on this list. One of the other things that I've been doing is trying to get a better handle on weekly versus daily rotations. And I started using this screen. You've seen this. This is the weekly. And now this is the same, but I changed that to daily update. And if I then rank the list on symbol, so it's alphabetically, but the reason why I'm doing that is now on both tables, the sectors are on the same line. So if I can now really quickly work my way through. So say materials, I now see the weekly position and the daily position in one graph or in one shot, I should actually say. And my screen size here is a little bit limited. I have a bigger screen where I have let's say these are 1/3. So I got 3 browsers, each in 1/3 of the screen. I got the weekly, the daily, and then the chart. So if I bring up the chart here, I do that in a separate window. If you got the idea, then I have the chart here. So I can, in one image, I can actually see daily, weekly, chart. So for me, this means materials inside lagging on the weekly, inside lagging on the daily, although it's curling up, not the best sector. So if we move on to communication services, this is sort of contradictory, curling up inside lagging on the weekly, but curling down on the daily. So I'm going to leave this because I don't think there is any synchronization, anything in sync going on. Energy, somewhat similar, long-term, inside improving, going down, daily, inside improving, just about going up, but far away from everything, so I'll let that go. Financials, this is the one that I want to dive in a little bit deeper later on, and the reason is very clear, because on the weekly, it is inside the leading quadrant and still traveling further right, which is a strong thing. And on the daily, it's inside weakening, but it's actually started to curl up. Let me see, yeah, here. So we had this rotation here, and now it's curling back up. It's pretty close to the benchmark, but if this rotation continues, then I think financials will be one of the leading sectors. We'll bring up the chart later on. Industrials, daily, very weak, and on the weekly, well, it is in leading, but it's not very strong. We talked about this last week. I was disappointed that it actually turned right over once it's hit the leading quadrant. And I don't see anything good coming from this rotation here on the dailies. Then we have technology, which is actually the other strong sector. It's inside leading on the weekly. It's inside weakening on the daily, but curling up. It's on the right-hand side, and you can see that it's actually starting to move up. And if I bring up this chart here, we see that technology is still a super strong sector. The relative trend is super strong. Here are the weekly RRG lines, so that's corresponding with these levels here. Nothing wrong with that. Maybe short-term corrections, if any, but the longer term picture absolutely bullish for technology, and that is a very important sector for the market, as is financials. Staples. Well, I mean, weekly very weak, and on the daily very strong. This sort of negates each other, but I prefer the weekly image because the longer term usually holds more value. Daily is more noise, and if you look at this, then the price chart is actually pretty good. But if we draw a trend line under these lows here, then that's been broken. So that'll be difficult, and these lines are actually starting to point down. So staples, not the strongest. That's defensive. Translate that to good or bad for the market. I think that could actually be strong, especially when you also see that real estate is rapidly going lower. It's inside improving on the daily chart, but it hasn't reached leading yet. And we have seen, if we make this there, you can see that it's already traveling quite a bit through that improving quadrant. And I have trouble seeing this rotating into leading, especially with this long tail here on the weekly, because this is where actually the strength is. Similar move for utilities, a little bit further ahead of the curve. Utilities, long tail into the lagging quadrant, which shows weakness, a lot of power behind that weakness. And we see utilities rolling over inside the improving quadrant. Already losing relative momentum, so very high odds that it will roll over. If we bring up that utilities XLU chart here, then you'll see that this trend line here is broken. These RRG lines are pointing down. If we zoom in here a little bit, then you can see that this is a double top. Let's make this into a daily. It's probably a better picture. See, like a double top completed. That old support level is now acting as resistance, like for 2-3 weeks already. If we break, let's put it at 62.50, 62 for sure, and then definitely when we break below 61, this thing is going down further. So people are getting out of defensive stuff. That's basically what this says. Bring this back to weekly and then go to the last two. So here's healthcare, strong on the weekly, not so strong on the daily, but it is the strongest sector. It's the furthest to the right, and it's going through a correction now. So with this long-term weekly tail crossing over into leading, I'm going to assume a rotation for XLV on the right-hand side of the chart. So that this one will pick up speed and join XLV into the weekly on the daily as well. Let's bring that onto a daily chart as well, and you can see that this is actually a very nice chart. We had this triangle-like formation that we broke. We got the initial rally. We're bottoming out on relative strength. I think any pullback towards the 95 area for XLV, and that could be, driven by this here. If this rotates a little bit further, then that could be a very good buying opportunity for the healthcare sector. And then finally, we have consumer discretionary on both time frames. On the weekly, solidly into lagging and diving further into it. Again, one of these sectors that is improving on the daily, but you see the shorter tail. This tail is much shorter. Observations are close together. It's starting to roll over already. So I wouldn't be surprised, or I'm going to assume that this tail will roll over before it will hit the leading quadrant, and then go into lagging and then be in sync with the weekly picture, which makes discretionary actually one of the weaker sectors for the time being. We'll do financials after the break. I'm quickly going to show you two RRGs that I think will help us understand what's going on in the broader market. The first one is growth and value. And here you see that growth stocks have rotated from weakening back into leading, while value has rotated from improving down into lagging. This is supposedly supporting a more bullish picture for the S&P 500, for the general market, and I do believe that that is true. And then let's put the other one on the other side. That is the what I call size indexes, market cap. And what we've seen here is that large caps are on the right-hand side. They're there for quite a while already. It's very hard to. This is a, remind you, this is a 5-week tail, and you can't really see it, can you? I mean, let me show you. You've got to blow this up to see that rotation of large caps. You know, very close together. If we bring this is so for the last, boom, 11 weeks. It's been in this little area here, while small caps are now starting to pick up really, and mid caps are inside lagging. Supposedly, allegedly, strength in small caps is good for the market as a whole. If we switch this one to daily, you will see that picture even better. You see small caps and mid caps just crossing over into leading. We have a bad day today, but you know, it isn't over yet. You got to look at the longer term rotation. I think that small caps are now actually one of the better segments of the market, I should say, actually. Okay, we're halfway through. We're going to a quick break, and we'll look at the financial sector when we are back. Don't go away, stay tuned. And that's it. Rachel, did we get any questions coming in?
Yes, we did. The first question is, how do Europe, Asia, emerging markets compare relative to SPX?
Oh, well, that's first of all, it's a very good question, but the answer is also pretty simple, because we do have a predefined groups called international stock market indexes. So we have Europe, which is right here. Oh, by the way, the benchmark here is the Dow Jones Global. And the question was relative to SPX, right? Okay,
Yes.
so SPX is right here, but if we want to make this picture relative to SPX, all that we have to do is change the benchmark here to SPX, update the graph, and now SPX is the center of the chart. So Europe is sort of, I'd say, in doubt. It rolled over, and now it's starting to move to the right, so it's almost the same. Let's see what's happening here. There's a lot of markets in Europe are breaking to new all-time highs, so it could be taking over for a little while. I'm not sure yet. I'm in doubt, but it's definitely not bad. They're probably both similar in nature. The other one, Asia. Asia is a big country, or a big continent, I should say. Different. Japan is over here, the Nikkei. So that's one. That's pretty good. Then we've got Hong Kong, which is far to the left and rolling over. So that's not too good. India was inside improving, but it's now rolling over. Because South Korea was rolling over. Is Indonesia, Asia? That's not good. China is absolutely not good. That's really bad. But anyway, the short answer is, you know, just load up this RRG predefined with the international stock market indexes. If you want to look at it against SPX, then just change the benchmark, and there's your picture.
Thank you, Julius. The next question is, we are told to trade what you see, not what you think. Well, I think the economy is humming along, but I see that the XLP is heading northeast. Is this counterintuitive?
I like the phrase. I think I know who wrote that not too long ago. Trade what you see, not what you think. Well, anyway, I sort of agree, but XLP, I mean, this is probably the growth value type stuff, and you know, defensive versus offensive. The economy is humming. It's all good, and that's why. Where is it here? Growth. Well, all these growth stocks are doing so good. Oh, whoops. Here are you, growth value. So this is why all these growth stocks are doing so good, and that's why all these defensive, or as we've identified, low beta stocks or sectors are now all there. I mean, yeah, XLP is it's sort of counterintuitive, but it's defensive. What is counterintuitive for me, though, is the weakness of XLY. That is what surprises me. I'm not surprised by the weakness in staples. I'm much more surprised by the weakness in discretionary. If in my mind, when the economy is strong and we have growth and all that stuff, then I would expect staples to lag and discretionary to lead. But they're both moving in the same direction. So that is counterintuitive for me. But again, trade what you see, not what you think. And what I see is that both these consumer sectors are in relative downtrends at the cost of financials and technology, for example.
Okay, Julius, and one more question if we have time. Rudy asks, the recommended benchmark for comparison of currencies is $1. Are there any other situations where the use of the one benchmark would be beneficial?
Oh yeah, ton of. Basically, anywhere where you would like to get a relative comparison against something that does not go down. I mean, if we look at, like, stick with sectors here. I mean, when the benchmark is SPY, even when SPY goes down, there will be a number of sectors that will go into the leading quadrant. That not necessarily means that they go up in price. It just means that they will go down less fast than SPY, which makes them outperformers. So this is the game where, you know, the market goes down 10% and a sector goes down 5%, which makes it a 5% outperformer, i.e. it's in the leading quadrant and it's a winner. If you're not into that game and you like to get a handle on, maybe we should call it absolute rotation, actually. I've never thought about that, but maybe that's relative rotation and call absolute rotation. If we just look at what we do here, if we change SPY to $1, then you'll see that, you know, everything is now to the right because the market's going up. You know, this is just a big up move. So our benchmark is now a flat line, as you can see here on the right, and everything's going up. So everything's outperforming that you know, thing that doesn't perform. The performer is 0. So they're all up there. So anywhere where you would like to get a handle on the absolute performance of a group of securities, then $1 can help you. The reason why it is used in currencies is because currencies are always a pair or a relative line themselves. You know, if we load up currencies here, then you see that they're all in terms of US dollars. So here now, the benchmark for this RRG is the US dollar, and you'll see all the other currencies rotating around that benchmark. Anyway, I wanted to do a quick take on the financial sector. that is a very big and important sector for the market, and it's doing very well at the moment, which is good. Let me quickly load up my chart lists for the XLF holdings. And we don't have enough time, and it will be pretty useless to actually go over all these stocks in that sector. These are the top 50 of them. Couple of things that I want to point out. First is, if you, and I've shown this before, if you look at the table, and you can sort that table on multiple columns. Right now it's sorted on the tail of the color, so which quadrant it is. If you actually sort it on industry, because everything is in the financial sector, that's for sure. But now we can get a handle on where the various industry groups within that sector are. And then you can see that the performance of this sector is primarily driven by asset managers and by banks. All asset managers are in the green, one is in the yellow. but it's actually a good one. We'll look at that later. Then a lot of banks, and then we have a few in weakening and turning up, and we got one in improving. Then there is, consumer finance, insurance brokers are weak. Investment services is a mixed bag. Property casualty insurance, all weak. Life insurance, pretty much all weak. And then we got some specialty stuff. So the industry group that is the best, or industry groups that are the best inside the sector, are asset managers and banks. Now, what I want to do is I went over a number of stocks while I was preparing for the show. And there's actually a whole list of stocks that are doing really, really well. Let me put it on symbol. This one I really like. And if we put that on here as well, that looks pretty good. It broke out. And there are a ton of these stocks that are actually looking good. BAC, BlackRock, COF, FRC, JP Morgan is the leader of the sector. Key, Morgan Stanley is really, really good. And then one that I want to pick out because I need to go work towards my pair trade idea for this week is T. Rowe Price Associates, an asset manager, not surprisingly. And what you'll see here is that it is actually rotating back up. So this is the weekly, and I hope the yellow is well visible. You see that it rotated down and it now started to move up. And if we switch this to a daily for T. Rowe, then let me find it for you. We're here, so now we're looking at the daily RRG, and you see that it has a similar curl back up. So this is pretty unique that it's on both the daily and the weekly curling back upwards. So T. Rowe Price will be the long side of my pair trade this week. On the short side, there is a ton that I don't like CMEs, Chicago Mercantile, AFL, AIG, ICE. But one that really caught my attention was PFG. Let's put PFG here. It's inside the improving quadrant, but curling down, rolling over on, this is still the daily. Let's quickly look at the weekly, where PFG is now on the weekly. Life insurer, there it is, straight into the lagging quadrant. So if we quickly bring up, so I had T. Rowe as the long part, and you see that it is pushing against resistance, well, pretty much already breaking it or broke it. And we got PFG on the short side, and this is, this is pressuring here. You see these highs coming in at lower levels, and it seems to have trouble staying up here. RRG lines are coming down. So my pair trade for this week is long T. Rowe Price and short PFG. Both are in the financial sector. That was it for this week, and it was the 11th episode of Sector Spotlight. Thank you for watching. Please don't be a stranger and stay in touch. Sector Spotlight airs every Tuesday, 10:30 to 11 a.m. Eastern. And meanwhile, if you want to read more about sectors and RRGs, please go to the RRG blog on StockCharts.com, or even better, subscribe using the link below each article to make sure you will receive a nudge every time a new article is posted. See you next week.